Thank you for attending the 2025 Multifamily Forecast presented by Gray Capital. I'm joined by producer of the Gray Report and Director of Communications and Marketing here at Gray Capital, Matt Bastnagel. Matt, how are we doing today?
Pretty good.
Want to first just start with a little bit overview of Gray Capital, who we are as a firm, talk a little bit about our research efforts, our research programs and reports that we've been publishing over the last year and a half, and then dive right into this exciting forecast for 2025 with a sharp focus on the multifamily industry. Some of the challenges and opportunities that we see are clear and present. But first, just a little bit about Gray Capital. Gray Capital is a multifamily investment private equity firm based out of Indianapolis, Indiana. We're a vertically integrated organization with in-house property management, construction. We acquire large, typically Class B and Class A multifamily assets, primarily in the Midwest, targeting Indiana, Ohio, Kentucky, and Michigan. We currently manage a little over 2,000 properties. We have a portfolio that we're invested in closer to 7,500, and assets under management are just over $900 million in multifamily assets. This year, we've acquired two properties valued between two of them a little over $114 million, raised about $50 million in equity from limited partners throughout 2024. And being an active participant in the multifamily market gives us a unique perspective on the market at large, not just as an outside observer, but having always had a keen focus on data, being very data driven from our acquisitions, but also just having a love for information economics and real estate is why we started providing more market research and data really at the beginning of the pandemic in 2020, which started with the Gray Report newsletter that goes out weekly, which you can sign up for at graycapitalllc.com/newsletter. And then turn over to Dr. Bastnagel. Matt, you tell us there's a little bit more about what you are doing at Gray Capital related to the research that we've been doing, some of the research briefs, and some of the success and some of the outlets that have picked up on the research that you and the team have been doing.
We have been putting out some research reports fairly regularly. Last year, we put out a report on the loan maturity wave and some reports on rent growth and how rent is kind of covered differently with different rent growth trackers. This year, we've been looking again into loan maturities, but also how that kind of intersects with extend and pretend, and it's gotten some decent coverage. I think it's helped contribute to the conversation, and whether or not we're participants or moving it, I like to think that we've had some influence and have a voice. And I think the issues that we're talking about, whether it's loan maturities or extend and pretend, or really our outlook for 2025 multifamily market, it's nice to see them come into focus, and I think that there's lots of actionable insights that people can really use. So we're trying to focus on the most important stuff for investors and for anyone that's kind of interested in the multifamily industry, and we do that every week too with the Gray Report podcast and YouTube series, and we also have a bi-weekly newsletter that we send out twice a week. So we're really trying to cover as much as we can, all the important stuff, and it's nice to sum it all up here at the end of the year.
Yeah. So I'd highly recommend subscribe to the Gray Capital YouTube channel. Subscribe to the newsletter at graycapitalllc.com/newsletter. But also, we do have this latest report that is being released today. If you go to graycapitalllc.com/report, you'll be able to download the full 2025 multifamily forecast, which contains the vast majority of all of the data and insights that we're going to be going over today. And as always, if you ever have a question about anything in these reports, anything in the videos, or anything that we do at Gray Capital on the Gray Report, never hesitate to reach out to myself or Matt. We're always excited to have conversations with whether it's investors, principals, sponsors, or other people in the multifamily commercial real estate research field.
Yeah.
We have interviewed quite a few of the brightest minds and most active researchers in multifamily and housing. We'd love to continue to do that. So if you are a housing expert, never hesitate to reach out. We'd love to have a conversation with you and interview you on the Gray Report. Well, that being said, Matt, let's just jump right into the forecast. put together a great presentation, and we're going to start with some general macroeconomic drivers that I think will set a really good foundation for the rest of the presentation. But we absolutely have to mention that yesterday, the Federal Reserve and the Federal Open Market Committee did meet to update their own projections. Their summary of economic projections was released, and there were some differences from the last time they released this information back in September. Certainly, I think was generally in line with a lot of our research and our forecasts as well. But I wanted to integrate some of the comments from Jerome Powell yesterday. I'm looking at the summary of economic projections. We've put together a summary that we might post out as well for that piece. And it's not a material change, but I think the theme of the new administration or the Trump administration coming into office in January, there's a lot of speculation of potentially higher growth environment, potentially higher inflation. And while it doesn't, I believe, change the long-term trajectory, certainly may have some impact on the short term, and adds fuel to the fire for why 2025 and really this next couple of years could be a incredibly exciting time in multifamily, and we could see some of the better investment opportunities really that we've seen in quite some time. So starting there, Matt, let's get into some of these economic drivers: stabilizing economy, cooling labor market, and inflation gradually cooling. Man, it's a whipsaw for both of these. Whether are we actually stabilizing, are we going into a recession, and is inflation actually cooling? So let's just start at the top. Stabilizing economy. What are some of the data points and the reasons why truly feel like we're in a stabilized economy?
I mean, just looking at the lines here, everything does seem to be kind of flattening out. Whether it is inflation or really the kind of employment numbers that we're seeing, and unemployment is still below historical norms, but it's getting a little bit higher. It used to be a very tight labor market, and now it's a little bit more loose. And the same thing with GDP. GDP used to be much higher than it is now, but it's still, for all that time, it's still above kind of, or just about around maybe the historical norms.
And we wanted for the longest time, over the last cycle, we had low GDP growth, low levels of inflation, and really deflation was a bigger worry than too much growth. If anything, it was an ideal scenario that we might see above trend growth above 2%. Certainly, we've seen inflation in the last 2 years. We've seen a little bit too much growth. But as we are coming down in the Federal Reserve, on their projection, has GDP growth coming in at 2%, for 2025. And so we're really kind of coming in right where we really should be. Not too hot, not too cold, and if anything, maybe just a little bit of extra growth.
I think that the calls in the worries for inflation, however they were stated in the Federal Reserve meeting and in the discussions that followed, are a little bit premature. I know that the inflation has ticked up slightly in the past couple of months, but the long-term trends are way more persistent. And also, we're going to factor in that rental housing has finally started to make a kind of dramatic dent, or at least a measurable influence in the CPI readings. And it has gone from, it was consistently 0.4% month over month growth to now it's 2.2 or 0.3, and that's down from 0.7 and 0.8. So things are falling in line in the CPI, and and they're falling in line over a long enough term that couple months of little tiny increases don't freak me out that much. And if anything, I would be worried about this consistent employment trend. Would this persistent high rates mean that unemployment may tick up a little bit more worrisome in a more worrisome way than right now, where absolute levels it's fine, but I just don't like the direction.
Yeah, I think some of the concern is with a little bit of higher growth, potentially lowering the unemployment rate maybe a little bit, and seeing some renewal of wage growth. Wages have been outpacing certainly rent growth and even inflation recently. Obviously, there's some catching up to do from the last several years, but I guess a reacceleration of wage growth, could lead to some inflation. But I guess we're really speculating on all of the reasons for all of that growth. I mean, the idea that potentially some tariffs could be inflationary doesn't really drive employment though, but certainly more deregulation in the economy. And I think the theme really is the mindset shift to a more business-friendly environment, and the idea that America is open for business should drive extra growth. Will that be at the cost of some inflation, or can we get some true growth without inflation getting out of whack?
And that does kind of dovetail with something we'll cover in a little bit. About the general sentiment for everyone. What is everyone going to feel, and is there going to be a measurable effect of the election changing people's sentiment, because so many people voted against the current economy, and so maybe they're thinking that, well, all right, and you got to have that sentiment in order to start some of these business enterprises and start hiring and stuff like that. It all begins with a gut feeling, I guess.
And try to back it up with some data.
But
just going over, before we move on to some more of the housing pieces, just from the Federal Reserve Summary of Economic Projections, they do have real GDP growth coming in at 2% for 2025. Unemployment rate is expected to stabilize around 4.2 to 4.3%. And inflation, they're projecting core PCE inflation to be right at 2.5%, which again, the target is 2%. But again, 2.5% really isn't that bad, assuming we don't have some really runaway, really wage inflation that can start spiraling out of control. But a little bit of above trend growth, again, assuming that it's healthy growth, isn't necessarily a bad thing.
I think that 2% is like negotiating power. Like, we're aiming for that, and it's easier to to kind of take them seriously if we're so far off target, because 2.5 is looking really good from where we're standing right now.
True. Now, the Fed funds rate, and this was the big move yesterday, the Fed did lower the Fed funds rate by another 25 basis points, with an additional 2 cuts forecasted for next year. That's a reduction from when they were forecasting 3 interest rate reductions, only 2. Again, it gives credence to maybe we're going to be seeing a little bit of more growth, but they're still saying that we'll need to cut because we're transitioning from a higher inflationary period that was mostly driven by supply chain bottlenecks and other things, but huge shift from a demand from services to goods, and now back again. So again, gradually slowing, which is right along with our forecast, but looks like a little bit of a jolt, at least in the first couple of years, given that, again, the economy may have a little bit of a shot of adrenaline in it, given the new Trump administration. But I think the real question, and this is going to then get into the housing market, is not necessarily on the short-term rates, but on the long-term rates. Looking at Treasury yields, we had the 10-year Treasury at 4.6% yesterday. I think it's 4.57 somewhat today. And with a lot of these multifamily owners looking to either purchase or refinance in 2025, in the large preference for longer-term fixed-rate financing, well, that's going to be indexed typically to the 10-year Treasury. If those longer-term yields do remain elevated, that's going to be a challenge for financing. But it also brings into question valuations and cap rates, which, while cap rates have not just stabilized, but we've actually seen some recompression over the last several months. A lot of that has been in anticipation of some faster rate of decreases. While we still think the long-term trajectory is slightly lower than it is today, it may be much higher than what everyone thought a normal environment might have been 9 months ago or a year ago. When a year ago we were looking at more than 5, I think it was 7 or 8 potential rate reductions throughout this year, and that just obviously didn't happen when we had housing inflation, according to CPI, never came down, and we just had some lagging inflationary effects.
And that's a good point. That has been a theme, whether it's the multifamily market or the economy as a whole, where 2024 looked a lot like 2023. And there,
do you think we'll have another one of those years? Will 2025 be different?
Getting to the the outlook, and the outlook. These are all the reasons why it could look very much the same. But on the other hand, there were a lot of assumptions that were underlying the stasis that we were in throughout 2024 that that made it seem so repetitive. And the same thing for 2023. Like we thought we were on the corner here, and now we're what we could be 3 years into a stagnant, at least like for multifamily, like kind of a stagnant market where low sales activity.
Yeah.
At what point
Low
does
growth,
push comes to shove, and now we're approaching the majority of a time horizon for some of these like 5-year multifamily deals or
Yeah.
something.
So, and really looking at, I guess the question is, will there be a catalyst for change, or
Yeah.
is it going to be a slow burn one way or the other? Well, let's shift to the housing market right now. Starting with demand, housing and apartment demand will remain high in 2025. We're pointing to household growth, looking at absorption, household growth rates, as well as home price to rent ratios. Matt, where would you like to start?
I'd like to start on the right, actually. This home price to rent ratio is, I think, the most important one here. It really gets to the heart of the housing affordability and of the choices that people are presented. And there's a lot of argument for high price of homes driving people to be renters. I think it's a little bit more complicated than that, but it also represents the difference in the price of rent and the price of home ownership represents a little bit of a cushion and an implied stability for the apartment market at a time when the housing market is the home price growth has not been as stellar, although it is growing positively.
Yeah,
But the
yeah.
rate of that growth has been a little weaker, by the month.
Low volume,
Yeah.
but prices have been stable.
Yeah, and it brings to mind this timing thing too. It seems that home prices were like this juggernaut that powered through a lot of higher interest rates, and now things are slowing down on the home buying side. Whereas for multifamily market for the last couple of years, it was the brakes we put on the brakes for 2 years.
So it's a little bit of a double-edged sword. On one side, if we see longer term rates remain relatively higher for longer, that shows some challenges to multifamily. It's harder to acquire, it's harder to refinance. Financing is more challenging, but at the same time, there's an effect of increasing demand on the renter side, and so higher demand, potentially lower vacancy rates means faster rent growth, and all on the lines of, if we do see more growth and we see more inflation, we see more wage inflation, that typically translates into rent growth as well.
Yeah.
And then when we look at the supply dynamics, so we can look at it here in just a second, it really sets up an interesting environment of where we could see some very strong rent growth. It's really hard to speculate out because that growth is going to be most likely, probably closer to 2026, halfway through 2026.
Yeah.
So it's really outside our 2025 forecast. We don't want to do too much speculation looking out too far into the future. But there's a potential really nice setup, Matt. If you don't mind, I'm just going to skip forward here and look at supply, because we're currently experiencing, like right now, today, a 50-year peak in multifamily deliveries across the nation. Now, different markets are a quarter or two ahead or behind in terms of where their peak deliveries. There are some markets that are past that level of peak deliveries, but you can see 2024 certainly was an incredible amount of deliveries, and right at the beginning, even 2025, it's really a fraction of the proposed deliveries, and really over the next several years, it's a fraction of what's been delivered over the last decade. And we have a housing crisis. We'll get into those numbers in just a second, but if we've also seen the highest level of absorption since the craze in 2021. If you take that over exuberant period out, it's the highest level of absorption over the last decade or so. Yeah. And so if we continue high demand, high absorption, but supply basically gets down to a trickle, easily could be in an environment of some explosive growth. Yeah. But just the details of that, we just don't have the data to really accurately forecast. But it is an interesting setup. What are your thoughts, Mike?
And we've talked a lot about inflation and the long-term trends of inflation being more powerful than the short-term trends of than the short-term bump in inflation. I think the real long-term trend is apartment demand, and housing demand in general. That is going to that's going to overwhelm anything over a period of time, especially if we're talking about long-term. Housing demand is going to be there. It's going to be there next year. It's going to be there 2 years. We are millions short of houses right now, and I think building is a short term will solve some short term pain, but it's not going to bring everything down at once. I think that in some places next year there's going to be probably a big impact. There's going to be lower rents because they built a lot. It's easy to fix it on the short term, and we've seen what happens when you build more houses. Well, we're turning that down, and that's going to have a really big impact going forward.
Yeah. Well, let's move to some of the affordability challenges, which tend to create opportunity in terms of rent growth. Matt, can you explain this chart? I believe this is from Freddie Mac.
Yes.
So Freddie Mac really looking at housing shortages over time, comparing 2018, 2020, and 2024. Matt, take us through
so
it.
they had their estimates. They did this 3 times. At least shown in this chart here. In 2018, they figured we had a total gap of 2.5 million homes. That's how many we needed. And that's to kind of alleviate the housing shortage pressures. And then they redid the study in Q4 of 2020. They found that gap had grown to 3.8 million 3.8 million homes is what we needed. Now, between 2020 and 2024, we did a lot of building. We did a lot of single family home building. We did a whole lot of multifamily building. But their reading went from 3.8 million to 3.7 million. They went down about 100. So the shortage was reduced. But if you actually read the report that it's connected to, the actual number did not decrease. Their calculations of it decreased, so it's only a nominal decrease.
Oh, interesting.
It's even by their own admission. Point is, we still have a huge housing shortage. That's not going away soon. And you can read housing shortage as another way to say we got a demand problem. There's too much of it.
Yeah.
And that's it in a nutshell. And the best we can do is build more, but it's really hard to build with high interest rates.
Yeah, that's true. I mean, equity for development deals, especially joint venture equity, has essentially been completely dried up for quite some time. At least that's what I'm hearing. I do know some developers who are successfully raising equity, but they're slightly capitalized a little bit differently, but it's few and far between.
And on the flip side, I'm kind of clarifying my thoughts here. We're talking long term and short term, right? Long term housing demand, I've faith that that's going to continue. Short term, though, in some of these markets, they're going to really explode with apartment supply. They are building. There's so many apartments that are currently under construction. We're still maybe we just passed the wave of high apartment supply. But for some of the markets that saw the most apartment supply, they're the ones that currently have the most apartments under construction. So the short term, even though we've got these long-term housing demand problems or housing shortage problems, the supply problems are going to be more keenly felt in the next year than any of them. 2025 is still going to be all about supply, just a little less than 2024.
Well, just because a property is delivered doesn't mean it's fully leased up.
Yep.
You have to go through, a 9 to 18 month. I've even seen process of getting that property fully leased up. And in that period, you're typically throwing concessions. You're doing whatever it takes
what do you mean by concessions?
Huh?
Just giving away free rent?
It could be $1,000 gift card.
Yeah,
it could be a month of free rent. It could be just where they're lowering the rent, some sort of incentive. And the reality is they're trying to accelerate that lease up time to either be able to get to a point where they can refinance or sell the asset, because that carrying costs, the mortgage, the construction loan that they took out to build that, even if they're on time, on schedule, on budget, that carry cost has doubled and tripled in some cases because their interest rate has exploded of what they had originally pro forma. Many developers, not all, many of developers have had to bring extra cash into those projects in order to kind of float it, to carry that debt service. And so they want to accelerate it and do whatever it takes to get it leased up into a position of stability so they can transact it and it's acceptable from the capital markets perspective to be able to be sold or be refinanced. We mentioned some different markets, different regions that are going to be behaving a little bit differently. We want to start looking at some rent growth estimates.
For sure.
Then we can get back into some of the rent growth estimates also compared to some of the supply forecasts and why that really is the driving difference. Even in the face of demand, despite strong demand, So yeah,
Yeah, for
where we
sure.
at, Matt?
And that's where I do think that their conception of how we are on this supply wave is going to be a big factor on whether you think it's going to be flat rent growth or whether you think that it's going to be 3.5% rent growth.
Yep.
CoStar, their 3.5% prediction looks a lot more accurate when you consider that their supply estimates, they had the biggest drop off of the supply. We don't have that in this report, but just trust me, they had supply getting cut in half.
Yeah.
Next year. Now that's not
Is
always
that the
case.
biggest difference? So we're looking at national projections, national numbers for rent growth in the United States from 1, 2, 3, 4, 5, 6, 7 different sources. What are the differences in these methodologies, Matt? And then I see Great Capital.
Well,
Is that just bring us?
I'm not
what
sure
are
about-
the
I'm
what
not
are the
sure about the
differences?
specific-
Because this is the one thing that I think that you do and that we do differently, or that's unique, is that we break down the methodology often when it's available. They don't always make it public.
Yeah.
But what are some of the different assumptions that are being made to where CoStar's coming out with a 3.5% projected rent growth, where Redfin is coming out at 0%? It is worth noting that there are no negative numbers.
Yeah.
And it's also there's some variability, but we're all, again, the average is 2.3, but there's a 3.5, there's a 0. So,
Unfortunately, like not all of them did, like a lot less than I would like, revealed their methodology. Although, we've done some work ourselves to look at it. I know that there are just like kind of rules of thumb. Like for our analysis, we looked at job growth, we looked at existing rent growth, and then we looked at the new supply that has come online. And the balance of that, you can get pretty close to it. Now, I think that some of them, with that in mind, then you can think, well, if you really think that there's going to be a lot less deliveries, that's going to mean the rent that your rent estimate is down. So if you don't think job growth is going to be
so the
strong,
three variables you mentioned was job growth,
Yeah.
Past rent growth history, rent growth, the trend, as well as supply forecast.
That would be my
Is
assumption,
the
yeah.
supply forecast the main driver and the difference between markets?
I think so. That because there's not a whole lot of people that have like a wildly different thing. The thoughts of recession are kind of long in the past. That may have been actually true at the beginning of this year. People didn't know where it was going, but not so today. I think the real difference is, do they think that we're going to still keep building like gangbusters, or keep delivering new apartments, or do they think that things are going to peter out? CoStar, the highest, not coincidentally, I think, thinks that things are going to peter out. That there's not going to be a whole lot of new apartments next year compared to this year.
Interesting. So let's talk more about, again, we got into this briefly, but where is the growth and the differences between the markets that are seeing a ton of new supply versus ones that are a little more balanced? And again, some of the markets that are seeing a lot of supply, it makes sense because there's a ton of population growth, there's strong demand, their absorption is even today doing really well, but they still are really struggling to move the rents and are often having to lower those rents. Matt, what are the differences between the Sun Belt, the Midwest, the Northeast, and then call it the Mountain West and California, Arizona, Colorado, those markets?
I think that the Sun Belt is one of the markets that has the most kind of job growth, population growth, and you'd think that would mean that they are invincible, that there's always going to be people that fill up their apartments. But this is another case where supply growth can create a short-term surplus of apartments, such that it makes apartment rent growth go down. In Orlando, for example, apartment rent growth is down 1.3% last year, and we have the forecast to be about 1.5. Now, for another state like Detroit, their new supply is only 1.1%, and their rent growth was 3.5%. So in the Midwest, they're seeing a lot less new apartments. I think the Sun Belt is the most cohesive region in terms of they all seem to have the same supply story, which is a lot of it. There's a lot that came online in 2024, and there's a lot that came online in 2025. When you're going into the West, it's a little bit more spotty. There are some markets like San Jose that hasn't seen a whole lot of new supply and has like a little bit stronger rent forecast. And the same thing with Sacramento. But then on the other hand, you've got places like Phoenix where rent growth has been negative 2.3 last year, and their new supply, their future supply is 7.2%, which is exceeding.
Which is still a lot. which
They're
is a lot.
5.9%.
Yeah, that's interesting. Now, so part of that is they're just seeing. I mean, Phoenix is still seeing incredible amount of demand, and so that's the other side of the coin is that they're still seeing the demand to justify some positive rent growth. Or
I believe that. I think that that part of it is hard. We cover every week. We cover the apartment market. We know that we know the supply story for each and every one of these markets, and we know about Phoenix. But sometimes you find someone and they don't know a whole lot. Maybe they haven't paid attention the past couple of years, and they think, wow, Phoenix, it's a growing market. Its long-term prospects are going to be good. But there's some short-term knowledge that would maybe inform that a little bit better.
A similar scenario, different. I think a little bit more extreme, and they have a negative rent forecast despite having incredible demand. That would be Austin. It's a little bit of a poster child. I think, to summarize many of the challenges, because there's been not quite a few foreclosures in Austin because just the speculation on Austin's growth really fueled a lot of maybe a little bit of malinvestment in many ways, of where especially syndicators were going in buying older value add deals at extremely low cap rates, assuming interest rates would remain near zero. They would be able to get excessive rent growth, and really looking at their business plans in a vacuum.
I don't think that it's a coincidence that these are exciting cities, that it's easy to tell us an exciting story about the growth. Austin's still having growth, and Phoenix is still having growth. People aren't moving out of there. It's just this
people are
supply.
moving in. 100, exactly.
Yeah,
it's just too much supply. It was if you look at some of the demographics and the metrics that you would look at when you're evaluating a market: population growth, job growth, wage growth. It checked all of those boxes. The data point that was absent from, I think, the calculus on deciding to build or to buy was who else is doing it at the exact same time I am also doing it. Because investors from all over the country said Austin has great metrics. Let's all go build there. Let's all go buy there. Everybody had the same idea. And to me, the Sun Belt is a theme of an investment thesis with solid fundamentals. Absolutely can't poke a hole in the thesis, except for it's overplayed and overbought. The good company, a good stock, a good investment can still be priced too high, and the price just got pushed too high as interest rates were dropped to zero. The money became free, and there was a feeding frenzy. And so if you wanted to get into multifamily, you'd pick up a book, How to Invest in Multifamily, How to Pick a Market. You're looking at job growth, population growth. And so it's been overplayed. And so that's where it looks like this year, Austin's seeing negative 5% rent growth. New supply coming in at 10.2%. Just this year. Future supply, it does decline to 6.4%, it looks like, but you still have a
future supply is units under construction.
Exactly, units under construction, but the rent forecast for 2025 still negative at 0.8%.
Yeah. Now, if you want to look at another one, Charlotte is an interesting. I would pair it with Austin as just these shockingly high numbers of apartment building that's going on right now. Their new supply 7.2%. Their apartment units under construction future supply 10.8%, but their rent forecast is a positive 2.7%, which is maybe even a little above the average of all the markets that are collected here. And it's because they got great job growth.
They do have just enough growth that can overcompensate for the amount of supply.
So for any of these markets, right? If their job keeps growing, and that's another thing, as much of the temporary power as apartment supply has on the market dynamics of apartment market, that's going to peter away. That's not going to be sustained. So
and as much of it is not just the new supply, but maybe the trajectory and the trend of existing growth. We're talking about past rent growth is a variable in calculating a forecast. And when you're at a trend lower and lower and lower, if that's factoring your forecast, so for technical reasons, there could be a bounce back in Austin, or maybe
because they had started.
If there's an over reliance on the past, but at the same time, I know how property managers and owners react. When you're seeing that so much competition. You've got a nice new apartment community, but there's 20 other nice new apartment communities. You're kind of doing whatever you can just to keep the thing full to generate enough cash flow to pay the debt service and pay all your expenses. It's hard to move out of that mentality to get back into growth, and so everyone is more having more of like a turtle strategy and survive and batten down the hatches.
Yeah.
And I've seen operators so many times do that for too long.
Yeah, no, that's really interesting too, because we talk in the abstract about, oh yeah, the apartment supply that's going to make the rents go down, but these are discrete decisions, and they're decisions made by often anxious property managers that are doing what they can to keep the lights on, or to make sure the occupancy is there, and they react quickly, and a lot more quickly than maybe they used to. You said it takes time to change that mentality, but like.
Well, and obviously there's a lot of more revenue management software that's being used today, regardless of the controversy with RealPage. But if you're not relying on that, or again, if you're just optimizing for occupancy rather than growth, you might be behind the eight ball. And we saw that back in 2020 and 2021. Some folks started moving rents as the market has been moving, and some folks kind of batten down the hatches for a little bit too long. So we talked about the Sun Belt as a theme of high supply, most likely lower rent growth, but really strong demand. So good long-term prospects, but the short and probably medium term is challenged.
Yeah.
Tell me a little bit more about the Northeast and then the Midwest. The Northeast, I mean, during COVID, everybody moved out. It was struggling, but it really has been a solid performing region since then. What are you seeing in some of those
Northeast,
coastal markets?
I'll just use like Baltimore here as the example. It's not like they didn't build it all there, and I think that's a very similar story for the Midwest too. It's
like
not
Baltimore's got 2% new supply, and future supply is coming at 1.7. I mean, that is dramatically different from the Sun Belt.
Dramatically different for sure.
And forecasted 2.4% rent growth, and they did 2.5% this year. It's at least positive.
And there's some definitely positive prospects in there, and other northeastern markets that just aren't listed here. But there's also, especially in the Midwest, there are some elevated levels of supply. It's just not as elevated. Like, yes, we did more building here than we did before. It's just going to be less. For instance, in Cleveland, their new supply is about 1.4, and the future supply is 2%. That's not so bad. But there's other places like, well, I guess in Milwaukee there's a little bit more. Really, all the ones that I've picked here, I picked pretty good ones that were good examples of the fact that the Midwest, they just didn't build as much, and you can really see a cause and effect there, not only in the actual rent growth, but in the rent forecast that we have for them going forward.
Well, and that's where the Midwest is in the spotlight a little bit, because it has often been kind of forgotten. It's just flyover states. There's more interesting things going on the coast or in the Sun Belt with that really high growth story. But they entered into a little bit of a Goldilocks scenario of where there was, moderate, in some cases strong population growth, but the perception is more of the Clevelands and the Rust Belt metros like Akron, Ohio, that have declining populations, no growth, no jobs. Kind of a 20, 30 year old kind of trope, which Cleveland does have much slower growth, and it's not my favorite Midwestern market. But then you have markets like Milwaukee, like Indianapolis. They're on this list, but like Columbus, Ohio, Kansas City. These are all markets that have very healthy demographic trends, population growth, job growth, and then the suburbs. See metrics that are similar to some Sunbelt metrics.
The reason why those aren't in there, because they're very middle of the road. I took the,
and we talk about them a lot.
We already talk about them a lot.
We talk about Indianapolis all the time
on the Gray Report. But just to fill out where I was congratulating myself for picking these like examples of low supply. I did take I picked.
It was because Cleveland, St. Louis. And Detroit's a little bit different, but those are definitely slower growth Midwestern markets than in India, Cincy, Columbus, or Kansas City.
Of a part of markets of cities of a certain, I set a threshold. The biggest cities, around 20 biggest, which were the 10 least, which were building the most and which we're building the least. So you have the 20 leaders or the 10 leaders and the 10 not builders, and these not builders are all in the Midwest. I don't think that's any coincidence. But The reason why, you get a middle of the road kind of market like Indianapolis, like Columbus, even kind of Chicago to a certain extent, is they're not building a huge amount, they're not building a little, but their stability has been to their benefit. And actually, Indianapolis is one of the top markets, not only for apartment rent projections for a lot of these outfits that are doing their own outlooks for 2025. It's also actually been called out as some of the best housing markets to watch. The NAR just had a report that came out a couple days ago that has Indianapolis as number one.
Well, it's interesting. You say that because a lot of those Midwestern markets, Indianapolis, Cleveland, Columbus, they're seeing strong or solid to moderate rent growth. But if you go back to the housing affordability on a nationwide, that gap is extreme, but it's actually much more narrow in some of these Midwestern markets. I remember Paul Fiorillo from Yardi asked me, when Indianapolis started being kind of the top rent growth leader, he's like, what's going on in Indianapolis? Like, tell me the story there. Well, and this is similar to other Midwestern markets. They're diversified economies. You had a lot of the heavy manufacturing jobs, left in the 70s and 80s, and the ones that are continuing to grow diversified with other industries that have grown. Now there's this resurgence in manufacturing as well, and so they have very healthy foundations, but they're affordable. That means there's the labor pools that can go to work in manufacturing. That's why the battery plants, the EV plants, the semiconductor plants, Eli Lilly, they're all building in these Midwestern markets that are the land is relatively affordable. There's adequate water. There's no natural disasters. And then the workforce is ready to go. Typically, it's a right to work state, less union presence outside of, Michigan and Illinois.
I like the story of affordability as a reason for businesses to move in. I sometimes resent people saying, "Well, it's so affordable." Does that mean that it's the last choice and the only reason you're moving there is because it's affordable?
It's just like it's on the reasons to on the reasons to list.
Yeah.
And so on one hand, it's like, okay, well, maybe there's not that extreme gap between renters and homeowners. There's more people that live in Indianapolis that do have the option to go out and buy a home.
Yeah,
but that also translates to what you were saying is it's bringing in net migration into those states as well. People are leaving Illinois, moving to Indianapolis, from Chicago down to Indianapolis, and even from some Sunbelt markets to New York and California, because of the affordability, the quality of life, because they actually can buy a house. And that population growth, that type of economic activity provides more wage growth and a general more economic growth in those markets that eventually translates to rent growth as well, especially when you combine it with a very moderate level of supply coming online. So again, a healthier economy is typically a net positive for multifamily. The last note that Matt I have on some of these regional differences, and it's really not because we're going to get into investor sentiment right after this. Removing myself from the seat of the real estate investor and looking at just like the cause and effects, because housing shortage in the United States, it is an opportunity to create generational wealth because it's a huge demand, and this country needs massive investments into housing of all kinds: affordable, new, luxury, multifamily, duplexes, ADUs, BTR, you name it. We just need new supply. We've had one of the best case studies over the last couple of years of the effects of new supply and specifically housing policies in different metros. Yeah. Now, for us, rent growth is a good thing because that means revenue is going up, our net operating income is going up, and that means our valuations are going up. But I'm switching seats with the renters right now. The markets that have rent growth is if rent growth were to be bad because I'm a renter, the markets that have had easier housing policies that have allowed people to build have incentivized building have actually been holding up pretty well. In terms of becoming more affordable. Think about Austin. It's not like Austin was cheap to create these rent declines. The rent got way too expensive. And because they were able to build so much more housing, that has brought down rents. And not only we see our rents declining in Class A units, they're also declining across the spectrum from B to C as an effect of lowering our rents across the board. So again, not thinking as an investor, but thinking as, just looking at this as a problem as an American We need more housing. We need more investments in housing, and we need easier zoning, less zoning restrictions, less regulations to be able to build more housing. Again, that's just it's not in my self-interest to say let's build, build, build. If I wanted to make the most money at Gray Capital, we'd say no more building apartments because then the rent's going to go through the roof.
Yeah.
It's very simple. It's almost too simple, but supply really is the key here, and it's been the driver. Obviously, there has to be demand as well.
Yeah, got to talk to your mayors and your city officials because this may not be a Trump administration problem because so much of housing policy is done at the city level. Unless you want to build on federal lands or something, then good luck living in the ranch land.
We'll believe it when we see it. Okay, now let's talk about investor sentiment, Matt. This has been interesting because investor sentiment certainly after interest rates started to rise in 2022, investor sentiment really bottomed out. But I think that tide has been turning, but this is an entire period of uncertainty. And people have lost money. There have been foreclosures. Equity has been wiped out, and it will continue to be wiped out in cases where assets are in distress because they were overlevered, bought too high of purchase price, whatever the case may be. But it looks like investors are getting back in the seat, and the dry powder that's sitting on the sidelines is getting ready to be deployed if it hasn't already started to. What are you seeing in terms of sentiment, and then looking at some of the data around it
This is one of the differentiating elements of this year versus last year. There is a clear positive trajectory for investor sentiment. I think Vibe Session has gone out of use recently. We heard it a lot at the beginning of the year, heard it a lot in 2023. But
the vibes have changed, I would say.
Yeah.
I would say it's no longer a Vibe Session, and now it's just a vibe.
Yeah.
Whether that's a MAGA vibe or however you want to call it,
Yeah.
but it's definitely there's a vibe going on.
Yeah. So many different sources are reporting improving investor sentiment. Specifically, there's consumer sentiment that is improving. But also, I think that pent-up demand after 2 years of inactivity is a real thing. We had less than half of the pre-pandemic investment activity in the past 2 years, and I think that probably hurts more for people because it was it was following incredible amount of activity during 2021 and the first half of 2022. But that being said, this inactive period has probably made a lot of people very anxious to start doing deals. I think that the best brokerages are probably doing okay. I wonder a lot about the brokers that are part of these 300,000 deals that didn't get made or something. That's just my own personal thoughts. But I think that, again, what is the results of all this, kind of the upshot, is in improving, whether you're looking at the NMHC Equity Financing Index, which is actually the highest it's been since January 2022, and that's actually at an absolute level fairly high. So people think that they're going to be able to get equity from investors, and in their prediction, and then strangely enough, and this was a Q3 reading, the debt financing index is the highest it's been since July 2019, and that's also a relatively high level, kind of historically. I don't know why we think that debt. Well, maybe it's just going to be improved from a not great position. They're probably expecting improvement.
If it's Q3, there also probably was a little bit of anticipation of further rate cuts. So if that survey was taken today, maybe a little less optimistic, but still, I think there's quite a bit of optimism. The other, if we look back, 2022, and then really throughout 2023 as well. The playbook was we're going into a recession. There's never been a rate hiking cycle that hasn't led to a recession. In some cases, the whole point of increasing interest rates was to, break the backs of inflation by really trying to kill the labor market, kill the housing market, and maybe bringing us into a mild recession to kind of reset things.
Well, then early 2024 SOM rule.
Exactly. Yeah. All these were indications of we're going to a recession. Yeah. So how do you get bullish on anything if you're going into a recession? If anything, people were, filling up the war chest, but they're saying, we're waiting for X or we're waiting for Y. Yeah. Now we went past X and Y and none of it ever happened. And we're in a relatively, as first slide showed, we're in a relatively stable economy. Things are relatively bright. There's a lot of optimism out there. And then what else is going on? The stock market. Even though there were some declines after the Federal Reserve meeting yesterday, we've essentially been on repeat all-time highs throughout the year. Single-family home prices not have only maintained, but they've increased a little bit. So there's a wealth effect going on. And whether it's a rebalancing of portfolios that investors have to do right around this time of year and saying, my equity portfolio has increased by 20% over the last 12 to 18 months, depending on what you're invested in. Well, maybe I need to rebalance and look at my allocation to real estate, especially when those same investors have been on the sidelines, especially since last week.
Yeah, since last week, since this huge plunge in the stock market. That's another kind of X factor. I didn't want to. It kind of goes against that idea of improving sentiment, but it's something worth watching though.
I think there are people who are taking profits again, getting ready to rebalance.
Interesting.
At the beginning of the year.
Oh wow! So we're kind of watching it happen.
Yeah, and this happens every year.
Yeah.
At the end of the year, there's always selling typically the end of December to rebalance portfolios into the new year. But again, all these folks have been off the sidelines because, in terms of real estate, because it's been uncertain. A lot of investors, have told me, waiting for the 10-year Treasury to get below a certain level. To many, that was 4. We got below that. Now we're above it again. Just that uncertainty has led to some inaction. But now, as the longer term picture starts to come into a little bit more clarity, the chance of recession is relatively low right now, outside of for some technical reasons like a reinverting yield curve. But when we look at that long-term demand, long-term supply, and these stable markets, you get really excited about investing in multifamily over the next couple of years, and how high interest rates go in the near term, and how much supply gets delivered over the next 9 months or 18 months. It becomes relatively immaterial if you're looking at a longer term investment. And so really, those 5 to 10 year investment windows, I think there's a lot more confidence being gained in rather than like a shorter term opportunity. Although there is potential that some short term opportunities could present themselves. It's just it's hard to speculate with much certainty that you can turn around and execute a business plan within 24 to 36 months, because we could potentially still be in a period of slower growth. We couldn't have hit that ramp up in rent growth where supply drops off. But if you give yourself 5 years, you have a much higher degree of confidence, especially when a lot of these assets are trading well below replacement costs, and developers are trying to really get out of them as quickly as possible.
That's why I'm kind of on the same in the same frame of mind as well. In that there seem to be much more reasons for people to take kind of optimistic action, and whether they're like selling or buying, they think, all right, things are going to get better. Whereas at the beginning of 2023, there was not that kind of optimism, and you weren't entering into a market that people were thinking they were going to be healthy. So there was less of a catalyst. We were talking in 2023 about loan maturities possibly being that catalyst, but there wasn't anyone independently that thought like, all right, if this loan maturity comes up, at least I can sell it into a market that will be okay. Back in the beginning of the year, it was not a market that was okay. Back in October of 2023, the market was definitely not okay.
And that's a good transition, because what led to there was a large concentration of loan maturities at the end of 2023 that ended up not happening. Not that they didn't exist, is because they were granted extensions in many cases, and the can was effectively kicked down the road. New York Fed did a big white paper on the effect of extend and pretend on commercial real estate, and now there's a new concentration that is basically, again, where the can landed is at the end of 2025, and this could be the catalyst for a dramatic increase in sales transactions and sales volume. But the kicker is, where those long-term rates will be. Because it's a big difference between if the 4 years below 4, the 10 years below 4%, or it's well above 4%. If it could be close to 5%, it's going to be hard to pencil deals, and equity is going to be wiped out. If it's below 4%, really some deals can start happening. Again, every deal, every market is a little bit different.
And every week it seems like the 10-year, not just the 10-year, but like the projections of the 10-year, the forecast that I was following for this report, every year they seem to shift up and down, or every week, I'm sorry. And like there was one point earlier in this report where there was like 50 basis points lower, and I was like, oh well, that's kind of goes a
Yeah.
little bit against our thesis, however kind of unformed as it may be. My thesis would be, yeah, a little bit higher for longer. Yeah, we're going to get a couple rate cuts, but we would have gotten four, if all went according to plan once upon a time. But I think that still, despite the higher interest rates, there are reasons for both banks, I think, and for borrowers to say, yeah, maybe let's sell it.
Well, yeah, well, that's the big question. The last research report that we released was an update on loan maturities, and a lot of it was based on the New York Fed's white paper. With the idea of look, banks and equity, like they're kind of done doing extend and pretend. It's time to put up. It's time to figure this thing out. How true is that? Because the question is, all right, they can say that, but how much are they bluffing? Are they playing a little bit of poker? Because if the owner says, yeah, I'm not selling it, you're gonna have to take it over. Do those banks actually want to take possession of those assets? They're not good asset managers. They don't want to do it. They didn't like to do it in the GFC. So who are they selling some of them to? The deals, the multifamily deals that are going to be in the most trouble are typically going to be much older vintage, value add deals that are in a rough market, in rough shape. They need a lot of work, and there's not a clear path to profitability. Who's buying that?
Yeah.
It's hard to insure those assets. It's hard to finance those assets in many cases. Again, they're not all, but many, they're troubled. Who wants to buy that? Now, there's some exceptions to that, but is it possible that there's further extend and pretend
that could be the case. I think. And
does that create a moral hazard?
That's possible. And just gaming this out, like I think that the loan maturities in 2023, in October of 2023, did have an effect on the market. There were probably
the prices are down, 20 to 30%.
So my assumption is that there are people. It's not a case where suddenly the apartment is completely unprofitable. They can't pay their debt at all. It's just so underwater, and they're like, fine, take it. I dare you. I think that there's also people that are just in a little bit of trouble, and they're willing to cut their losses and sell much more than they were in 2023. But also that was also maybe happening a little bit in 2023 where they were a little bit below the line they wanted to be, and they were like, all right, well, we're going to sell for a little lower, and that's what helped contribute to the loss in value.
I think there's this continued optimism that, all right, pricing is going to get a little bit better in a little bit. And so for the lender, they would agree and they say, hey, we think interest rates are going to come down. Pricing is going to get better. You're a good client. Let's revisit this in a year or so. Just that's happened so many times. And there's a point where that has to stop. So we are looking for increased sales activity kind of regardless, especially compared to 23 and especially compared to 2024. Whether that translates to stable and higher prices because we have a robust economy, dry powder coming off the sidelines, and interest rates at least remaining in their range. Or if the 10-year Treasury really starts to get out of kind of go off the rails and gets closer to 5%, we could have some deals continuing to be extended or some deals brought to market and sold at a loss. But there is still most likely, at least in my eyes, equity in some cases was still going to be wiped out in some deals that are relatively underwater, especially on some new development deals where they were just over levered with preferred equity. Preferred equity came in as kind of a rescue source to fill in some of those gaps, whether that's to make debt service payments or to kind of bridge it to without an alternative to a capital call. But that pref is essentially debt in many ways, especially soft mezzanine financing. And that's further weight on the deal. And a lot of opportunities that we've underwritten, a lot of new development, that equity and oftentimes even the pref is gone relative to our valuation. So that still has to be worked out. Some folks will say it's a great asset. It's performing well. It's occupied. We've hit our rents and we're actually able to pay the debt service. Maybe our equity's wiped out, but I want to bring more cash into that deal to keep it, wait another 5 years, and just wait it out till I can get the valuation to get my deal out. Others will say, I don't want to put good money after bad.
Yeah.
Time to just cut my losses and move on to the next thing.
Yeah, I'm wondering if this 2 years, because any extensions that they may have gotten in 2023, let's say they got 2 years of extensions.
Yeah.
If they were in trouble enough to need an extension, are these extensions mean your interest rates are lower? I'm not really. I don't really know. I'd like to
No,
think that the
usually-
problems. Yeah, the
No,
problem.
your term is extended, and you have to typically bring more money to the table.
Okay. Yeah. So it's just exacerbating the problem. If it's not,
Yeah.
and no sudden solution for apartment rent growth was found between October 2023 and now. So I think that like, what if you were in the bank's position? Something's got to give. I don't know. Maybe they will just give them another free pass, but I don't like to think that.
So I think the 10-year is truly the wild card right now, and there's so many influences that could push the 10-year higher or lower. A stronger U.S. dollar, which the dollar is basically kind of peaking right now relative to other currencies over a 2-year period. That's hard for commercial real estate. That sends rates higher. On the other side, and I talked about this on the Gray Report recently, Matt, it's possible that we could see a return to foreign buyers of U.S. Treasuries, given the excitement in the United States being kind of the safe bet, a safe haven. If there is more purchasing of U.S. Treasuries, that will help with rates. That is kind of relying on China, which is going to be in the crosshairs of tariffs, returning back and buying our treasuries. Not super confident that that's going to happen. Japan is still a big buyer of our treasuries if they step up. Other nations, I think that's the one part that I don't hear being talked about enough. If there's that return to foreign investments into treasuries, and there is, on that note, there's also a likely return of foreign investment to commercial real estate. As well.
That's the JLL recently had a report that reported, global investor interest is on the way up for sure.
Yeah. Well, we've talked a lot about the 10-year Treasury, a little bit and we've mentioned the Fed funds rate. This is a dot plot. This is from December's meeting, Matt?
Yes, this is the December one.
So they haven't updated. We'll update with this with the recently revised.
No, this is the most recent one.
Oh, from yesterday. Okay.
Yeah.
Wonderful. Okay, so this was the most recent dot plot from the FOMC was revised compared to the September meeting, with now only two rate cuts forecasted for 2025, and with some longer term cuts coming down, considerably, but it's certainly much tighter than it was at the last meeting, and they're tempering. But as we said earlier, they're still calling for rate cuts. Now, they could cancel those rate cuts, but there still is a call for rate cuts to kind of accommodate this soft landing, no landing, as inflation generally recedes over time. But I think there's a little bit of trepidation based on, again, what the new administration policies may or may not be, and that effect and all the secondary effects that may
I was trying to work on like an animation where it would show like here's how it slumped down. It does look like the little blob of dots they all jump up a little bit.
Yep.
And it's kind of squished to the upper range of their projections for each of the FOMC members. I think it's kind of surprising. It doesn't look like we'll get much under 4% for the federal funds rate by the end of 2025. And then 2026 and 2027, we're looking at maybe getting around like 3% on the longer term. But if anything, it's like 2025 is the stasis year before FOMC thinks that they'll be able to get
rates
down and down.
Yeah. Well, Matt, that really sums up a lot of the details of the report. I just want to remind everybody that they can pop on over to our website, greatcapitalllc.com, where you can sign up for the newsletter. Make sure you get this report. If you want a copy of the report, it's greatcapitalllc.com/report. I think there's an icon probably on the main website, or there will be very shortly. To download this report. I think we may also be posting the presentation somewhere as well.
If you download the report, you'll also be able to, there will be a download link for the webinar slides for sure.
Now, if you are an accredited investor, and if you're interested in learning more about Great Capital, some of our offerings, you can hop on over to the website as well, book a meeting with myself or any member of the investor relations team. We'd love to have a conversation with you, as, again, this is now speaking more from Great Capital and the way we're looking at the market. And before we're just going to we're going to head out and appreciate everyone for watching. But we're excited for 2025
Yeah.
because we see, especially even with the prospects of slightly higher 10-year Treasury, in my mind, that adds more fog of war, that adds more uncertainty, and that creates opportunity for us, again, because we are not short-term investors, we're longer-term investors, and I have a good deal of confidence in the longer term. Now, I can't time whether it's going to be 2026, 2027, 2028. I have an idea about 2025, sort of, who knows, but I have a little bit better idea of the longer-term trajectory based on big picture, macro, looking at supply, looking at some of these market dynamics, and where generally I believe that we're going to be. And so we're going all in again on multifamily in the Midwest, with all of the manufacturing, all the advanced manufacturing jobs that have been coming to, whether it's Indiana, Ohio, many of these states. It's really exciting. I think that there's going to be an energy, and there's already been a mindset shift in the United States where we're going to see some growth. If we can see some deregulation, if we can see some more pro-business policies.
Speaking from your perspective in your conversations with investors, how would you say the sentiment is among the people that we're talking to?
Our sentiment amongst our investors is very high. Now, I can't speak to investors that I haven't spoken to recently,
and they're not always high. Their sentiment's not always high.
So I've told the story a handful of times. I mean, at the end of 2021, before the Fed announced rate hikes, if we had a deal, people were just throwing money at just any deal.
Yeah.
I remember that at the end of the year, end of 2021, going into 2022, that like November, December, there was just money being thrown around. Investors were lining up to do deals. That's when some of the worst deals were done, by the way. And we didn't do a deal then because it couldn't make sense of the pricing.
Yeah.
A couple months later, Fed announces they're going to start raising rates. That sentiment got turned off.
Yeah,
People got spooked. I mean, I told the whole team, I was like, we're looking at deals completely differently because we're going into a storm. Batten down the hatches, no more floating rate debt, no more bridge loans. Like, let's get ready to go. Over the last 9 months or so, really this year, but last 9 months or so, I've seen a big turn. People saying, I've been on the sidelines for long enough. I love multifamily. I want to continue to allocate to the asset class. And then as we have done some good deals,
it's always right after we're done with deals, then like we get 500 investors want to invest.
That happens sometimes, but we are, if not every day, every other day or so, an existing investor is reaching out to us and saying, look, I'm ready to allocate and I want to go.
Yeah.
And so we have one investor who reaches out that says that's an indicator that represents several other investors.
Totally.
So again, there's that wealth effect. People are looking to rebalance their portfolios, to allocate. And again, if you have a longer term vision, you can hold on for 5 years, 7 or 10 years, you can make some really smart decisions. You are going to have to accept some lower cash flow in the first year or two. Honestly, lower cash flow than I would like to accept, but that's just the reality. If you want to buy at the extremely strong basis and to be able to take advantage of the growth in a couple of years, you can't buy after the growth has already taken place. You have to buy before. But with a longer term perspective, I don't have to time it exactly right. I don't have to time it by year one. The growth happens year two.
Yeah,
it can happen along the period, and we'll be able to hit it right just because we were buying so far below replacement cost, where it gives us a high degree of confidence. Certainly, nothing is certain. There's always risk. We don't know. You can't know all the details. But the whole point of doing all of this is to arm ourselves with the best information, not just the most information, but the best information so we can make the most well-informed decisions. All of our decisions are data-driven. I mean, we do this. We first started doing this when I say this, I mean the newsletter, the Gray Report, all of our research efforts, we started doing it for us, wanting to be able to aggregate, quantify the information so we can make effective decisions. We said, we're not doing anything too special, but we think it's valuable and we want to share it with individuals. And that's where we've seen a lot of success, Matt, that you have had a huge role in. You've really led up the efforts. And that's, paired with obviously the acquisitions team or, world-class property management team as well to get, to execute our business plans. But it's because we've been well-informed and not just on real estate, but also, macroeconomy, capital markets, because if we would have kept pursuing the same acquisition strategies
Yeah.
back in 2022, we could have ended up in some tough spots like other syndicators are finding themselves in today or have
Yeah.
found themselves in. But we find ourselves in a position of strength, having done solid deals, grown our investor base, grown our portfolio, and really proud of what we've built and looking forward to what we're going to continue to build in years to come.
Yeah, agreed.
So thank you again for taking the time to watch the Gray Capital's 2025 Multifamily Outlook. Again, feel free to reach out to us at graycapitalllc.com. My name is Spencer Gray. I'm the president and CEO of Gray Capital. Been joined by
Matt Bastnagel, Director of Communications and Marketing at Great Capital.